This segment sponsored by Foster Financial.
It's that time again for Money Monday, where we provide you with holistic financial advice from Foster Financial. And joining me today is their Vice President, Caleb Doan. Good morning, Caleb.
Good morning.
Welcome, welcome.
Thanks very much.
Okay, so we are again continuing this conversation about market correction. And so each Monday you've been sharing some really great nuggets about what it looks like currently and ways that it can actually benefit, your finances if you invest it properly. Okay, so kind of recap a couple of things we've talked about and then share what we'll talk about today.
Yeah, definitely. So, we've seen a lot of volatility in the market so far this year. It's down year to date still if you look at something like the S&P 500. And so, we never like to see the stock market go down, but that correction can create an opportunity, oftentimes tax opportunities for clients. And so we've talked about repositioning from variable annuities. We've talked about, diversifying away from highly concentrated positions. Today I'll talk about what's called tax loss harvesting, which is something that helps save clients taxes at the end of the year. And it's only available in after-tax brokerage accounts. So this wouldn't be for somebody's 401k or IRA. It would be in their after-tax brokerage accounts, but it's a really great way to save on taxes.
Okay, and so let's talk about the drop in it all. And so what does that look like? So when you do the harvesting, what does that mean specifically when it comes to the market correction?
Yeah, so I think it's easiest with an example. So let's say that somebody bought $10,000 of Coca-Cola stock and it lost $3,000 of value, went down to $7,000 there. If somebody were to sell Coca-Cola at that $7,000, that would be a $3,000 realized loss right there. And they would be able to write off that $3,000 realized loss on their taxes at the end of the year against their ordinary income, which is a nice little benefit. It allows you to save money on taxes there. I think what people might be thinking, though, is, hey, I feel like I've heard from a lot of financial advisors, if the market's down, to not sell my investment, right? Because then it doesn't have the ability to recover. And that is oftentimes the case. The thing that most financial advisors are getting at with that is don't sell when the market is down and stay in cash. Because of course, if the market recovers, then you're not invested in anything, you're not able to go up. With tax loss harvesting, we're not selling and staying in cash. We're actually selling out of Coca-Cola and we're eventually going back into Coca-Cola. We can't do it right away. You have to wait 31 days there. And so sometimes we'll buy Pepsi in the meantime and then we'll get right back in Coca-Cola. If we see it recover from 7,000 back up to 10,000, great, we're still invested in it, but we've now pocketed that $3,000 loss that we can write off.
Okay, but what if, typically when someone exits and enters the market, it may be at a different share rate. So let's say that you were to exit Coca-Cola, like you said, and then you sell, you recover that harvest loss, and then you want to re-enter. Wouldn't you re-enter at a higher rate?
Yeah, I guess it depends what that stock has done in those 31 days. And that's why even within those 31 days, we don't just stay in cash. We go into a temporary position for those 31 days. And the idea is to go into a temporary position that is correlated with whatever position we sold out of. So if we think that, both Coke and Pepsi are down year to date and they're both kind of moving in about the same pattern, great. If we sell out of Coke, we'll go into Pepsi for 31 days and then we'll go right back into Coke. That way, if either of those stocks have moved, then we've moved right along with them.
Okay, got it. And so when people utilize this option, can they do it for every stock? Are they just able to take all these losses, or is there a max each year?
Yeah, there is a max. So your max is $3,000 every single year that you're able to write off. But if you have more than that $3,000 realized lost over the course of the year, that can be carried forward into future years. And so if this year we have a net $6,000 realized loss, we can write off $3,000 this year and then write off $3,000 next year. So it's nice that it carries forward to future years too.
Yeah. And how should people consider where they are going to roll over their funds if they do decide to kind of snatch it out of this crazy market right now? Like, is it an option to roll over, or rather a smart option to roll over to like a Roth conversion?
Yeah, as far as Roth conversions, it's kind of a separate type of account from the ones where we would do tax loss harvesting in. Roth conversions can certainly make sense when the market is down as well. That's something we've talked about in previous weeks as well. So there's kind of all those strategies that we take in tandem, and we see here are these things that really apply when we see a market correction, and then we can look at the client and say which of these are actually going to save you money. And if Roth conversions make sense, we'll do those. If tax loss harvesting makes sense, we'll do that as well. But certainly whenever we see the market move, it's important to decide, hey, is there anything that can help save the client money?
Right, exactly. And so I know that the decision between leaving the funds in the account or taking it out during this volatile time really depends still on that risk level that you feel comfortable with. Like, do you want to ride that wave, or do you want to take it out? And I think one major question people may have is, if they ride the wave, is there a possibility, just in your experience and seeing how the markets have gone up and down, that they will possibly make a full recovery? Or is it like, too much has been lost at this point, you're not going to fully recover?
Right, yeah. So everyone's financial situation is different, right? Everyone has different income needs and goals and things like that. So, we never want to give sort of the blanket statement to everyone. At the same time, last year, the S&P and even partway through the beginning of 2025, the S&P 500, for example, hit all-time record highs. And so at any point in the last, 50 years prior to those record highs, if you bought into the S&P 500 and held it, you were at a gain. And that's if you held it the entire time. A lot of times people get themselves into issues when they're selling when the market is down, of course. And so it depends on somebody's time horizon, whether it makes sense for them to stay invested. But our firm is still expecting a full recovery. And when we think kind of long-term about the stock market, we're still very, very optimistic. But there can still be those short-term fluctuations.
Right. Okay. Good info. Thank you so much, Caleb.
Yeah, thank you.
And if you would like more information about Foster Financial, we'll have their website and phone number listed below so that you can call them for a complimentary consultation. And I'll see you after the break.
This segment sponsored by Foster Financial.